In chapter 8, we're still focused on managing your credit, but we're now going to take a more in-depth look at credit cards. So you ready? Let's go. We'll look at the background on credit cards, credit repayment, how to review the credit card statement, explain credit card regulations, offer tips on using credit cards, and explain how managing your credit fits within your financial plan. Okay? Once again, let's discuss some of the advantages of using a credit card. No need to carry large amounts of cash. There's free financing as long as you pay in full each month. That's important. You get a monthly statement for record keeping. So, for example, for my business, I have a business credit card, and I'll use my business credit card statement to track my monthly expenses. I try to record or use that business credit card for all of my business expenses. Disadvantages: can make purchases that you can't afford. So, as I mentioned before, using credit cards can be a false sense of security where we're going to acquire items that we would not have purchased if we had to pay cash for it. Allow spending beyond your means. So I always give advice to my clients. If you live beneath your means rather than above your means, you will always be okay financially. Now, I'll say it again. If you live beneath your means compared to above your means, you will be okay financially. Excessive spending can continue with minimum payment. So, what you will see is that when you are steady putting things on credit cards and you're only making the minimum payment, it can take you a very long period of time before you pay off that credit card because of the amount of interest you're going to be paying. For example, how a loan of $2,000 grows over time, assuming an interest rate of 1.5% per month. Okay? So here a loan that you took out for the amount of $2,000. Again, this is the time period going from 1 month over to 10 months. Notice that over that 10-month time period, that loan for $2,000 has now grown to $2,321. So be cautious of the interest that you're paying when you use an actual credit card. When you're applying for a credit card, they'll ask you for personal information. They'll look at your cash inflows, your cash outflows, your credit history. They'll look at your capital, your collateral. Do you have anything of value in the case that you default on that credit card? And of course, they're going to obtain a copy of your credit report that we discussed back in chapter 7. Okay? They may look at your income, your existing debt level, and the current economic conditions. These factors all play a role as to whether or not you're going to be approved for an actual credit card. Now, the most type of credit cards are MasterCard, Visa, American Express. I should also have added Discover card to this list. These are the most popular types of credit card. Now, some credit cards are universal, meaning that when you have a MasterCard or a Visa card, those credit cards can be used in most establishments. Then you also have what we call your retail credit cards, which are specific to that retail establishment. So you may have a Macy's card or a Nordstrom's card or even a gas credit card. When you have a retail credit card, those credit cards are only to be used for that particular establishment. Okay? Credit limit. This is the maximum amount of credit allowed. So look at your credit card statement. What is your credit limit? That tells you the amount of credit you're allowed to put on that particular credit card. Now, a lot of credit cards have what they call overdraft protection. What does that mean? It means that if you go beyond your credit limit in making your purchases, they will still allow that transaction to go through. However, that credit card company often will charge you a fee if you go over your credit limit. Some credit cards have annual fees. I recommend you find a credit card that does not have an annual fee. Credit cards do have incentives such as gold card, platinum cards. Some cards you can rack up airline mileage. Other cards give you cash back, other perks. So make sure before you decide on which credit card to apply for, you understand what incentives that credit card may offer, if they have an annual fee, things of that nature. Okay? Grace period between the time of purchase and when the payment is due. Now, I absolutely love using credit cards, but I use them wisely. I like the fact that I can buy something today and pay for it maybe 3, 4 weeks later. And as long as the amount that you owe is paid in full, you do not pay any interest. Okay? Understand the terms of your credit card. Does it have a fixed interest rate? Is it variable or is it tiered? So, of course, when it has a fixed interest rate, which is for most credit cards, it's going to have a set rate. If the rate is variable, the rate is going to fluctuate. When you have a tiered rate, it may say, well, if you spend between 1 and 5,000, we'll charge you 10% interest. Between 5,000 and 7,500, we'll charge you rate 12% interest. So if it's tiered, they may charge you a different interest rate based upon the amount you're charging on that credit card. Okay? Now, there are regulations on interest rates, meaning that there are regulatory agencies that will monitor the rate that companies can charge on these credit cards, which is a good thing. However, these credit cards, some of them are still having rates as high as 29% interest. Now, question for you. Do you know the interest rate you're paying on your credit card? Okay? Cash advances. I strongly recommend that you do not use your credit card for cash advances, because the rates often charged for cash advance are going to be higher than your normal credit card rate. Now, in the actual credit card contract, it will tell you those rates, so make sure you understand the terminology in that actual credit card contract. Okay? If you want to know more about how to calculate interest on the credit cards, how to calculate, you can go to the CNN website. They have a section about personal finance, and they have calculators that you can put in the amount that you owe, the interest rate. They'll show you the interest that's going to be accrued on that credit card. Okay? Finance charge is the interest that you must pay as a result of using credit. But once again, if you pay your full balance when it's due, you're not required to pay any interest. That's the beauty of using credit wisely. The average daily balance method was used by them to determine the amount of interest you have to pay. They'll look at the average daily balance on your credit card and apply that to a specified interest rate. For those who have to take business mathematics, and if you take my course of business mathematics, I explain to you how companies determine the average daily balance on your credit card. Then with the previous balance method, with this approach, they'll take the unpaid balance from the previous statement and they'll take their time to a certain interest rate to determine the amount of interest to be applied to your credit card. Okay? With the adjusted balance method, Interest is charged based upon the balance at the end of the new billing period. So they'll look at what's your balance at the end of the new billing period and charge you interest. So you can acquire from the credit card company what method they're using to apply interest to your credit card. Okay? There's something called the simple interest rate, the percentage of credit that must be paid as interest on an annual basis. Okay? So that rate will be given on your credit card statement. Then they have the annual percentage rate is the simple interest rate including any fees charged by the creditor, I'm sorry. So once again, I need you all to look at your credit cards and see what type of interest rate are you paying. I encourage you to do comparisons among potential lenders to see which credit card company is offering you a lower interest rate. But once again, I'll keep saying it, if you pay your balance in full, the rate doesn't matter because you're not paying any interest. So of course, the larger the interest rate, the higher the interest payment. So you want to find a credit card that offers a lower interest rate. Impact of financing period on credit payments. The total interest paid depends upon the length of the financing period. So the longer it takes you to pay off that credit card balance, then you're paying more in interest over time. You're like, yeah, I'll pay this off in a year, 2 or 3 years. Yes, you can do that, but just be mindful of the longer it takes you to pay off the balance, the more you're paying in interest on that credit card. Okay? Here's a chart showing a simple interest rate. So let's say that you have a loan amount of $10,000. This is showing the simple interest that you would accrue over a 4-year period based upon the interest rate being 6%, highest rate being 20%. Now, your credit score, credit rating, will have an impact on the interest rate that you're being charged by the credit card company. If you compare the rate of 6% over 4 years compared to 20% over 4 years, there's a huge difference in the amount of interest that you're going to pay. Plus, let me caution you, when it comes to credit cards, they use what's called compound interest. What does that mean? It means they take the balance on your purchases along with any unpaid interest, they add those together, and then you pay interest based upon that total amount. There's some good stuff, ain't it? All righty. Well, hang in there. Stay tuned. I'm going to come back with part 2 of our Chapter 8 lecture.